Okay, this is being recorded. One thing I do say at the beginning of all these webinars is if you're not familiar with the strategy or you're new to trading options, watch this again so some of the nuances will sink in. And another thing is if you watch it relatively soon after again, it will actually stick into your long-term memory and you'll remember it a little bit better. If you wait a month down the road, it's just not going to be the same thing. And this is another options workshop, long put calendar. We can also use this for earnings. So this is another good earnings setup strategy, although we're getting closer and closer where we're starting to see volatility in that further duration expiry. We're starting to see that volatility already start to creep up for some of those earnings plays. So it could be a little bit more difficult, but I got a lot of ideas that we can look into for this strategy as well if we can't find all the earnings ones. But long put calendar, let me get a couple of things out of the way real quick. My name is Eric Wilkinson. Some of you may recognize me as the Wolfman from CNBC, Fox Business, or the Wall Street Journal for my commentary on everything from economic to geopolitical and market analysis. And I've been trading my own money for well over 20 years. It actually started before I even moved to Chicago to work at the Board of Trade. I started trading in college with some money I'd earned and decided to switch my degree from psychology to finance. And then after graduating, I moved up to the Board of Trade, started out as a runner and still kept trading my brokerage account, and then moved up into the pits and started trading in the pits as well. And in that time, I've traded everything from stocks, financial futures, commodity futures, currencies, and options on all of these products in all market conditions. One other thing, you can follow me on Twitter. I'm at Wolfman's blog, or you can follow Pro Trader Strategies at Pro Trader Strat. I usually tweet out some snark and other things, and Pro Trader Strategies tweets out stuff for events that we have upcoming and or deals or stuff like that for different webinars. Got to go over this disclaimer. It says any opinions, news, research, or analysis, other information contained here by or material provided by Pro Trader Strategies and or associate companies is for general commentary and does not constitute investment advice or solicitation to buy or sell any of these securities or strategies we're talking about. And the reason why we can't do that, it's a big no-no for one with the SEC and CFTC, but another reason is I can't really do that not knowing your risk parameters, not knowing what's already in your portfolios, and I may be talking about some stocks or other ETFs or other stuff in here that's already in my portfolio, and I'm not trying to get you guys to living off the cliff to buy or so I can pump and dump it or whatever, any of that stuff. I'm just telling you guys what I have on, and therefore they fit my portfolio. So you got to take what we teach you in these, play around with a little bit, and implement it into your portfolios in your own way. And please remember that past performance of any trading system or methodology is not necessarily indicative of future results. All right, now that we've had that stuff out of the way, like I mentioned, this is going to be on the long put calendar. If you remember last week, we did it on the long call calendar. It's really similar in nature to that. One beauty with the put calendar, if we get a pullback or any type of movement directionally right with this strategy, you will generally see implied volatility expand, which is exactly what this strategy is all about. We're trying to take advantage of volatility expansion. It's a total volatility strategy play. And the way we set this up, I like to talk about the front expiration month first. So in selling that front at the money or just out of the money, and I generally will use that just out of the money put in the nearer expiration. That's the one we're going to be selling, and then we're going to be buying an at the money, or what I usually look at is the out of the money put in the further expiration cycle. One caveat to this is when this front month you don't have a whole lot of time left in it like we do now, you can go a little bit closer to the at the money. But I generally default to about a 45-ish delta on the one that is out of the money. Picking the right strike. Now, like I said, picking the right strike seems to be pretty mundane with this because we're picking the same strike in the near expiration and the further expiration, but we're going to be looking for the one, generally speaking, I like to look for the one that's closest to around a 45 delta out of the money option. And picking the right duration, this one, we want to pick the right duration in that we can take advantage of the theta decay in the front month that should decay faster than the theta in the further duration expiration cycle. But one thing to keep in mind with this is that we have close volatility. And I'll show you that when we pull up the platform, but we want our vol differential to be very close. But one thing with the duration, the reason why we want to take advantage of this is the duration that's going to be the one we're selling. And this is why we're going to be selling that one, because we're going to get the faster theta decay in the one we're shorting. And that's what we want to see. We want that, take advantage of that decay in that front month, and then we don't see as much theta decay in the one that we're buying. We never really want to see theta decay happening in the one we're buying, but it's inevitable. It's couple of things in life you can't avoid: taxes and theta decay when you're trading options. So we're going to try and exploit theta decay here and try and hold on to theta decay back here. And if we get volatility expansion, this downward slope will actually level out a little bit through here. It'll kind of, volatility has a tendency to hold off or staff off theta decay. So it'll start coming out a little bit deeper, and then when you see the theta decay or the volatility come back in, then you start seeing a drop more like that. We don't want to see this drop here. So that's why it's really important to implement this strategy when there's very low implied volatility, because then the probabilities are volatility will expand during the cycle of this. If you get into it in a high volatility environment, you will be disappointed really quickly when that starts happening. And picking the right environment, like I mentioned, low implied volatility, we want to see that expand, and the right environment with this is where our expiration cycle in the near term, the January in this cycle, is going to be very close in relation to the February. And we want that to be within 2 percentage points, 2 Vega percentage points. And I'll show you that when I pull up the platform, how we want those to correlate rather closely. Perfect scenario would be if volatility in January was higher than the volatility in February, because then we would be selling more volatility. So when volatility comes out, that decay will happen more rapidly, as well as we're getting paid for that volatility in that near term expiration. So if it's higher, that's even better. If here, I'll pull it up real quick and it'll show you what I'm talking about, just so we can get this out. So we want this volatility right here to be very close in relation to this volatility. In this regard, you can see this is the scenario where I'm talking about where it would be over. This is a rare occurrence where you would see volatility be higher in the near expiration than the one that we would be buying out here. So it's in that regard, it doesn't need to necessarily be within 2. It's actually a negative, so that's good. But generally speaking, what we would see in something like, let's look at the diamonds. So in the diamonds, so this is what I'm talking about. This is the volatility, or the Vega, in the front month. It's 11.44. We would want this to be, 2 percentage points. So 13.44 would be 2 percentage points if it was just 13, then that would be inside of that 13. So this is just slightly outside of that. And, you know, if we really wanted to play it in this, that's pretty close for government work that we could probably get away with that. But generally speaking, the general rule of thumb is we want these to be tighter than 2 percentage points in distance. So I hadn't looked at that Lulu, and that Lulu might be one that we look at to implement this strategy in. All right, so, and then picking the right, let me get rid of this real quick, picking the right underlying. For instance, like that Lulu, we want our option that we're trading to have a lot of volume and open interest. So in that, we want to have a tight bid ask is ultimately what we want, because when things start getting wanky, volatility starts going up, we're going to see that bid ask get a little bit wider. But if we're in the ones that there's a lot of players in there, there's always going to be somebody willing to give up a little bit of edge for us. So a rule of thumb for picking the right underlying, if it's a $100 stock or less, we want that to be 10 cents wide. If it's over $100, one of the things I talk about is just moving the decimal point in that dollar value 3 ticks to the left. And if it was a $300 stock, it would give us a bid ask of 30 cents wide. So we move that decimal point 3 ticks to the left, we get about a 30-cent wide strategy. If it's a $1,000 stock, we want that bid ask to be inside of $1. So some of these other ones like AutoZone and stuff like that, everybody's heard of those types of stocks, but there's just not a lot of players in those option strategies. So I usually will stay away from those. So if you watch my daily market commentaries, you will notice I almost never talk about AutoZone, because I stay away from that one because there's not enough players in there. And then knowing our exit strategy before entering the trade, this is always one of the most important things to know, right? Once we go through all our rules to set up this strategy and it fits with all those previous rules, the strike, the duration, the environment, the underlying, then entering this strategy, we need to know what our target is for this. I'm not looking for taking the full boat on anything. I mean, if you guys watch my daily market commentaries this week, you saw that on Wednesday, or actually I think it was Thursday, yesterday, I put on a target trade, bearish target trade, and took it off that day. I mean, I did a $3 wide put spread. Max profit on that would have been $1.50. I usually look for taking 50% on that type of strategy, and I got out in a day for 50 some odd cents. So, you know, I'm not going to risk any more than that. Of course, today, you know, hindsight being 2020, I probably could have gotten a little bit better, but, you know, one day I get 50 cents on something that my max profit was $1.50. I'm going to get out. With this particular strategy, with the long put calendar, we're going to be looking to take 30% the value increase in value. So an example of that would be if we had to pay $1 for this, we would be looking to get out 30% increase, which would be about $1.30. So that's what my target on this is. And you know, you're almost never going to find one where you're just paying $1, but you get the gist of that, a 30% increase. And the reason why is because this is a low probability trade. Anytime you're doing a debit spread, it's a low probability trade. So you want to look to get out rather early. All right, so the max profit on this is unlimited. It's unlimited in that the stock can go to zero from where we entered this, so it's really not unlimited in a sense. But you know, in options speak, a lot of times they say when you have a long put or a long call, your max profit is unlimited, and that is only after we let that front month expire and hopefully expire worthless. But what we're going to be doing for our max profit, I'm going to be looking for that target of 30% increase, and I'm going to be getting out. I don't really want to take this strategy longer than I have to. If that front put expires, it usually means because my directional assumption is incorrect. So if that is the case and I have to take this to where that put is worthless, it's going into expiration, I let it expire worthless, I'm going to usually let that long put ride through the earnings, especially if I have it on for an earnings trade. Or if it's an ETF or something like that, then I'm going to just kind of let it ride and expire worthless. That's the one beauty in debit spreads or defined risk strategies, in a sense, is I usually will let those run out and ride off into the sunset and just play it for what it's worth, and hopefully it ends up working out for the earnings if we have that. And then our max loss is always the premium we paid in a debit spread, or anytime you pay a debit for any option strategy, the max loss is that premium you paid. That's no different here. Even though we're going to have somewhat of a naked put in the front because it's not really covered in that front month, we still have that long put to really define that risk. And so your max loss is that premium you paid. How long do you typically hold this strategy? Great question. This one is tough to say on that. You know, like if I said like the Iron Condor, I think I usually hold that one probably for 2-3 weeks to get my 50% of my max profit. With this one, it's really dependent on volatility. So I don't really have a time target on this necessarily, but a profit target. And as soon as I get to that 30% mark, then that's that 30% increase. That's what I'm looking for. This one could happen rather fast, and it's all dependent on how volatility treats us. So we're going to see our max loss happen rather quickly if volatility goes down on us rather than expand. So that's another benefit of if you can find volatility higher in that near expiration than the further expiration, you know, you're selling a lot more premium that's going to decay than you're going to be losing in that back month. So I don't really have a time target for this, what it usually takes, but it's usually 2-3 weeks, just as a ballpark. And again, break even is long put option minus the premium paid, but again, it's a ballpark figure. This is as close to I can get for you on what a break even would look like. At the end of the day, it all depends on volatility, expansion, and contraction, and how it's going to affect this strategy. So, you know, it may even decrease after the front month expires because you've collected all of that premium if it expires worthless. All right, so let's pull up the platform because enough of the boring stuff. Yeah, it does have 2 break-evens in a sense. Once you have that short put, it's going to have the break-even on that one as well. But at the end of the day, it's going to adjust, and it's a little bit harder to determine in that front month. That's just kind of why I didn't really mention that one necessarily. I will mention it in here, but it does have it on here. And that max profit, max loss, and break even are really with the mindset that we no longer have that front put on anymore, that short put, just to save a little confusion. But when I go into the analysis of it, I will show you the other break evens. It's a little bit easier to figure out. Excuse me. So this is usually the time of the webinar where I ask you guys to start throwing out some stocks that you guys like to trade, and we'll run through all the rules that fall into that. Like I mentioned with the IV percent, we want this to be really low. So this is what the number is that I'm talking about, low volatility. And with this strategy on stocks, I like to look at the ones that have an IV percent of 0, of course. And as a matter of fact, I put the IV percent over here in my watch list column, and I usually sort them from highest to lowest, as you can see here. But on that. Having said that, from the lowest, then I'm going to start out usually at the bottom, and I will just start clicking on these or straight up from the bottom up. I don't even look at what the stock is, and I look at the chart a little. I usually will look at the chart because most of these stocks that I have in here will have tight bid ask. They're the ones that have kind of made the cut. All right, we got first one. Let's look at it. What is it? CLH. All right, so I don't know if I've ever even really looked at this one. I mean, it's had a big move to the upside, just had its 52 weeks highs, so it looks pretty good. We can look back at the charts, see when it looks like they have earnings. Do you know when their earnings are? I can check real quick. So they have earnings that fall right after, it looks like, they're on February the 22nd. So has low implied volatility, so that fits the bill there. We started looking at the bid ask on our puts, and they're 20 cents wide for a $50 stock. So that would be one reason why I haven't traded the stock, and even 50 cents wide on these. They're quite wide, so I wouldn't even play with it. The reason why is because if things start getting lanky, these are just going to get really, really wide, and because people are going to go to the other ones. It does have the tight volatility. It's definitely within 2 percentage points. They don't have the March cycle in here because that's the one where they're going to get their earnings. All right, so let's move on. I wouldn't trade that one. It's just not got enough. I mean, you can see nobody has really even traded that today, and the open interest is really small. So for options, I would stay away from that one. All right, so let's look at United Steel. And as you can see here, they have a lot of open interest. It's a $35 stock, and you can see that it's 4 cents wide. That's really good. There's a lot of players in here all the time too. Do they have the tighter? It's about 7 percentage points wide. So that means that the one we're buying, we're paying a lot more for the premium due to volatility. Those premiums get pumped up when volatility goes up. And that means I'm going to be selling low vol, which is the one I really want the high vol in, and I'm going to be paying a lot more for this. So I would probably discount that one. Who else do we want to? You want to look at the diamonds? So we can look at the diamonds. I mean, even though this is pretty tight, like we mentioned before. It's got low implied volatility. It's a ETF. So usually an ETF, I want this to be below 15% because ETFs are a basket of goods, so they will generally have less volatility in them. And usually when I'm talking about selling strategies, I want the volatility to be above 50 for stocks and above 30 for the ETFs. In this, for the stocks, I want this to be below 30 and below 15 for the ETFs. So it's pretty close in regards. It's, a $200 stock, and as you can see here, it's basically inside of 10 cents even for a $200 stock. So just to do an example for this, let's go to the 45-ish delta. So it'd kind of be a pick'em. One thing we also don't want to have happen is to have this like tank immediately after we implement this strategy. But we're going to look at the 45 delta strike in the front month. It's going to not be the same back here. It'll be pretty close, but we're going to kind of go closest to the 45 here. So let's look at the selling the 198s. So I'm going to sell down the 198s. And then I'm going to look to buy the 198s in the further duration in the February. So I'm expecting to get more theta decay in the front than I am in the back, and this got a little, that's a little weird that it goes up right there, but as a decimal, if this went out to more decimal points, it's getting rounded up, you would see that there is actually more theta decay in this front than there is in the back. All right, so let's look at the Analyze tab for this one. So we can see our break-evens on the Analyze tab here. So this is what we're looking about. One thing to do with this strategy, always flip it over to the Analyze tab, because this is really where you're going to see what your risk versus your reward is. And I always want to see my reward to be a little higher than what my risk is. So this one, it's 135-ish to the downside, and we're barely breaking 100 to the upside. So I would probably put this on a short list if I was really wanting to get some downside with this one. The one thing that I was talking about, we got our standard deviation move. So let me get the gears up, price slices. So let's switch this over to standard deviation just to give you guys an idea as to where one standard deviation move is. Because I would like also to have my break-evens relatively close to where this one standard deviation move is. It's hard to find, but it is a possibility to find that. And then, another thing we can do is click over here on this little gearbox with Think or Swim, and it pulls this up. So this is a volatility adjustment. So what this does, it allows us to see what happens if volatility were to start increasing with this particular underlying, if the stock doesn't move. So if we got our perfect world, you can see right here, this is where we're trading currently, and to get to that peak, it shows we are slightly bearish with this strategy. But if we were to get volatility to increase for us, you can see all of a sudden the line starts moving out. We don't increase our loss to the downside. Our debit paid is 153, so I don't know why this isn't going down to, oh, it's 153 to the upside. And that's another thing. It goes to the, this is not symmetrical on the max loss here. But you can see as volatility starts increasing, all of a sudden our max profit starts increasing to the upside. So that's what we want to see. Obviously, if it starts going to the downside from where we implemented this strategy, you can see our max profit starts deteriorating and our break even start coming in. So we don't, that's why we really do not want to see our volatility to contract on us after we enter this. And you can see these are our break evens, and they start tightening up even more. We don't have much room for error when that starts happening. All right, so let's look at a different one. So we'll go back to the trade page. So keep throwing those out there to me, you guys. We got some time to take up. So let's go back to that Lulu one. And if you guys have been watching the daily market commentaries, you know I have a Lulu trade on. I'm short puts here, and I'm also short the underlying. So for the getting put that stock on an earnings trade. So so we want to look at the bid ask on this. You can see that it's 4 cents wide. We're going to be looking at like the 45 delta-ish on this. The reason why I like this one is because it's got higher volatility right now, probably due to the big drop that all the retailers have seen. So we probably find this kind of anomaly happening in most of the retailers. So in this regard, probably wouldn't even really care that we aren't getting an earnings event or a binary event in here to get that expansion. So if you get this happening, then Chris, I'll check yours out here in just a second. We don't really need that binary event happening here, because we're going. This is a vol play. We're taking advantage of the vol in the front. So I'm going to look at around the 45 delta. So I would sell this put here and then go to, they don't have the 94s, of course, so they're going to make it difficult on me. So I'd probably have to go and, I'm going to have to sell the at the monies or something here. I could probably go to the 62.5s, even though that doesn't get my 45 delta. I would write kind of like this, trade with this higher volatility in the front, so we can see what it looks like. So we'd be paying 76 cents, and we obviously got paid a lot more for the volatility here than we had to pay for the volatility here, as we can see here, 3% difference. That's pretty perfect world. So let me get this down to 1. So let's analyze it and get rid of this stuff. So we can analyze this, squeeze this in, slide that over. So we can see that's our, see how it put our break even very close to that 1 standard deviation move. Let me just switch it so you can see it with the lines. So it's very close to that. So if we get a little bit of down move, you know, we're only risking $76 and we're getting almost 150 at our max profit on this one. So that would be a great scenario to have. We're risking half as much as what our potential reward is. That's hard to find, but that's what will happen when you get that volatility flipped like that. All right, so Chris wants to see IWM. Let's delete that one. So IWM, we could be looking at 45-ish delta. It's not going to have the half ticks over here. We got the 16 here, 16, 17, 18. So it's pretty close. You know, and with my assumption of the market going down, this would fit with that assumption. So I might bend that rule and let it stretch out a little bit, because I get directionally right with this. It would work in my favor. So we would sell the 135s. We have 135s here as well. So we do that and check out what our risk reward is on this. We're paying $1.33. So let's go to the Analyze tab. You guys that watch a lot of these different webinars that I've done, you will see that I don't usually check the Analyze tab that often, but with this one I check it every single time, just because I'd like to see what my risk reward is on this. It's hard to figure out your total reward with that front month. And again, we would see with volatility expansion, that's what we would need to have happen. And would get that if we got our directionality right. So this one I'd probably put on the short list, because it doesn't really fit with my risk reward that I want to see on it. So let's look at another retailer. Let's look at Macy's. I haven't looked at Macy's in a while. All right, so Macy's, we got 6 cents wide, you know, 3 cents wide in the calls. It's a $30 stock, so that fits. So what's its volatility percent? All right, get my, I want to give me, volatility percent is 18, so that fits that rule. So if we were bearish on this one, we would start looking at around the 45s delta. What is the risk reward you're looking for this strategy? For this strategy, better than 1-to-1. I don't want to risk more than my potential reward when implementing this strategy. So at least 1-to-1, you know, a perfect world would be risk 1 to make 2 in this one. And that is conceivable, especially if you can find a situation where you have higher implied volatility than you do in the back. So what did I say, the 36. So let's look at the 36s. Sell the 36, buy the 36, and then let's analyze it. And I'll bet you we get a better risk reward on this. So again, our reward is almost twice as much as what our risk is. Oops, let me go this way and slide this out and see again our one standard deviation move is very close to where our break even is. I mean, it's not, you're almost never going to find with this strategy the break even outside of one standard deviation. I can't ever remember seeing that. I've seen it come very, very close to it, but at the end of the day, it's usually, you know, you just want it pretty close. And we would be bearish in this being puts. You know, sometimes if you switch this to a little bit higher, we can see where we can adjust. So you can adjust your strategy. So if I moved it to the 37 puts, you can see we're now slightly bullish to get to where our max is. Yes, Chris, M looks very good. As a matter of fact, this is going to be on the short list for me. So, you know, retailers have been getting punished. I guess a lot of people are thinking that the sales online were better than at the brick and mortar. So, you know, check it out on Monday. As a matter of fact, so, you know, I'm going to pencil this one in to look at again on Monday. So another one we could probably look at, somebody's got J&J. Can you go over the IV on stocks versus ETFs, please? Yeah. So for stocks, because stocks will see their IV fluctuate more. For one, they have the binary event in there, and the binary event is the earnings. Anytime you have an earnings, you know, like for Fed Fund futures, the binary event is the FOMC, when the Fed governors meet and move rates. A binary event is just a known event that will affect that underlying or that related stock or future in a sense. A binary event for Macy's would be their earnings, and they probably, I don't know when their earnings are. So one thing, their earnings are right after the day after the February contract expires. So it probably won't see that volatility expansion, but now we're just looking for that volatility to contract in that front month in order to get to our max profit. And you'll almost never see the, here, I'll throw this over here. Get off my screen. So we kind of, with this, when we're doing this as an earnings setup, we want to be buying in here and then selling a clean month right in here. So that would set up for this one. I don't think Macy's has, they have their March. Oops, no, they don't have March, they have May. Gosh, they don't even have April. So we kind of want, setting this up, we got to check the chart, and you know, because I have the profile on here, it gives me the expansion so I can see exactly when their earnings are. It's the day after the expiration, or is that a couple days? Sorry, I thought they expired on the 20th. They expired on the 17th. So it's a few days after that expires. So these are actually both clean months, but as you can see, they've had some downward pressure for sure, and a lot of these retailers are looking like the worst could be over. Another thing with Macy's, it's come right down to this point of control, which is basically where the most time has been spent for this particular one. So that could be a very good comfort zone for it. So if we get that just to flatten out here, we're going to see that volatility really come in that front month. We would be able to cover this one relatively quickly. some of the other guys that have been getting, we can look at Merck. Merck has, it's just outside of 2%, but let's look and see when their earnings are. So Merck has the clean month right now that we're in, and then gets their earnings in here. So that's one of the things that we're starting to see, is a lot of the ones that have the earnings landing here in the February contract are starting to see that volatility start to expand rather quickly already. And so we could put this one on the short list as well. So let's go looking for that 45-ish delta. Low implied volatility percent just makes the cut here. It misses the cut here. So we'll just have to look and see if we really want to do this with our risk reward. So we're doing the 59s. We can't do the 59s. 59, they got the 59 and a halves. So we'd have to go to the 60s. So those are the ones that are at the money. So let's just look at the ones that are at the money then and add that in there, 74 cents for this one. And then, so let's look at the Analyze tab. So we're going to be risking the $74 here. So that's going to be our break even to the downside over here, $74. And then we're not getting but $50. So we're risking more to make only $50. And look how narrow these two come into play with one another. They're like on almost on top of each other. So it's so narrow, and you can see how much room there is to get one standard deviation to that side and one standard deviation to that side. So our probabilities with this one are pretty low on succeeding. So I would stay away from Merck then. So let's look at a couple of ETFs then that we can do. Anybody bearish gold? You can look at gold. Oh wait, here I'm going to go to let's look at gold. Delete this one. So does gold have inside of it? Does. So this is going to be a total expansion in IV play since there's no earnings for this one. So let's look at the 74 and a half. So our 45 delta is the one that is a half tick, and we don't get that one here. So we could either do a pick 'em between going a little bit less than that 45 or going a little bit more. So in this regard, then you could kind of go and look at what gold's been doing. Gold's been going down. As a matter of fact, I think it's had its biggest bear turn since, I think I saw since 2007 or something. So obviously in a bear trend. But it looks like it's consolidating, so maybe, you know, it could level off a little bit. So that would be, if I think it's going to kind of level off and trade sideways, that's when I'm going to go closer to the at the money. If I think it's going to continue down a little bit more, then that's probably when I'm going to be looking at that 45 or lean towards the 40 delta. So let's just say we think it's going to trend sideways for a little bit and then kind of start tailing off. That's, you know, if it's trend sideways and then continues with that trend, then that would be the time to go tighter. So we can look at both of them. Sorry about the dogs in the background. So our break even is going to be our downside is going to be the $84. That's going to be what we're risking to the downside. To the upside, it's almost looks like it's right about a 1-to-1 ratio, right? It's pretty narrow. It's on the break-evens, or our break-evens in comparison to the one standard deviation, which is, we'd like it to be as close to that one standard deviation as possible. It's, you know, pretty even though, and it's a 50-50. So it fits the rules. but you know, I put it on a short list. To me, Macy's looks best for this strategy right now. Do you close one leg at a time on this strategy? Only if it is not working out. If, for instance, we're bearish on this when the market rallies, that front month expires worthless, the Jan expires worthless, I'm going to leave it on. And that's the only way I'm really going to leg out of it. I never leg in and out of strategies. You know, if you know you get put stock or something like that and you add strategies onto it, or if you're doing covered calls, well then yeah, I will get out of those. I look at those a little bit differently when you're using stock and then options. But with defined risk strategies or other strategies, iron condors, any of my other ones, you will rarely, if ever, see me leg out of the strategy. You're going to end up costing yourself. You're going to probably leg out good 50% of the time. You're going to leg out bad 50% of the time. The problem is the times that you leg out good, you're only going to be making a couple of pennies. And the times that you leg out bad, you're going to be losing nickels and dimes. And it's just not worth it. You know, when I traded on the floor, we would do that all the time. I mean, we lived and died by legging in and out of strategies, but you know, we had better opportunity. We could see what was going on in the markets a little bit easier than you can on the screen. So it is too difficult to do in this day and age, for sure. You will literally lose more than you will be able to benefit from it. So in this strategy, the only time that I will, you know, in a sense, synthetically leg out of it is if the strategy is not working and I let that short put expire worthless and then just leave this long put on for the duration. All right, so JWN is another one. All right, hold on. I have a JWN. So Nordstrom. Sorry about that, you guys. So Nordstrom, first thing we look at, has tight bid-ask, which is good. There's a lot of players in here, and they have higher volatility in the front and the back than in the back. Let's just make sure that it's a clean month and don't have their earnings. They don't have earnings in either of the 2 months we're playing. It comes right after the expiration on there. So it's total vol play on that front month. All right. It's retail rich. All right. So they got the wanky, because did they just do a split or something? Must have just done a split. Because I can't. So we could go with the 70 or 47 and a halves on this one. So we'll sell it because it would have the same strike. So 80 cents here on the risk, which I like. And it's really close to there. It's a little bit wide on that side, so we're risking the 80 cents to the downside, and we have the possibility of making 100. So we're risking less than we have the potential to make with this, which is good. So that one will work. So we can also check out. Yeah, I think I looked at Nike earlier today, and it wasn't looking like it was going to work out. But I'll check it out again. Maybe something's changed. So let me just delete this one. All right, so with the Kohl's, we can look at this one. It's pretty close. Check out for their earnings. Their earnings fall just after that cycle there. So I don't know if we would see that expansion. I think Macy's still looks better, but it does fit everything but the earnings event and this, so that's a couple of strikes against it. I think I'd skip this one and probably lean towards that Macy one on this one for the retailers. We can look at, what was it, Nike? Let's check out Nike. So Nike, it's pretty close to inside that. They just had earnings, you said, so what were their earnings better? So their earnings were better. I would have a tendency to think that that's going to migrate up then, since they beat earnings. I didn't see what their outlook was though. So I'm probably going to lean towards Macy on this one for sure for the retailer sector. We can also look at a couple other ETFs like, let's look at XLY, which would be the consumer staples ETF. So it looks like they're kind of breaking down a little bit. They'd probably fall a little bit with the retailers possibly. So let's look at the trade page. They've got inside of 10 cents for a pretty big stock. So again, we could look for the 44. They got the 82 and the 82, so we could do that one. So we'd sell the 82s in the front and then buy the 82 puts in the back, paying 65 cents for it. Let's analyze it a little. So we're risking $65 if it rallies up. We're bearish this obviously because right here's where we're trading. Get to our max prop, we need to go down, and we're making only $50 some, so that one isn't that great. So yeah, looking like Macy's is. We can look at a couple other ETFs. Look at XLV. Oops. Go to the trade page. So the healthcares, we got inside of there. Let's delete this to look under 14, which meets that parameter for the ETFs. Remember we said under 15, so that works there. 45-ish strike is going to be the 69s. So we'd want to sell those and buy the Feb, sell the Jan. $56 is what we're risking here. Let's analyze it. $56. It's not looking that great. So I'd probably skip out on it. Does anybody else have any last minutes? I don't want to keep you guys all hanging around chatting with me all night when you probably have places to go and people to see. Anybody? SPY? Excuse me. Happy holidays to Eric and all the staff. Thanks again for excellent and very informative educational information and instruction. Thank you, Chris. I appreciate it. Happy holidays to all you guys, so I don't forget to, and to you as well, Chris. All right, so one more we'll do, SPY. Let's look at the trade page here. Delete this one. Do I run a trade room? I usually just do the daily market commentaries, but anytime, one thing I'll talk about is about that, like if you guys ever have any problems with anything and want to talk to me, run something by me, I have a no inbox policy with my email, so please reach out if you ever have anything at all that you want to talk about, and I'm more than happy to chat you up. So SPY. So, oh, actually, SPY I just put on, I did this week, so for the daily market commentaries, you can see this is the SPY trade for the calendar that I put on. So I sold the 224s and bought the 224s here. So I already did that one for this one, and obviously it's kind of gone up and sideways. It's up a little bit of money. It's not a barn burner right now, but I did put that one on for there. So I hope you guys all watch those daily market commentaries, because literally I talk about everything that I'm doing and how I'm managing it. Just, I talk about the good, the bad, and the ugly. It's not, I'm not like one of those Twitter traders that they only seem to win. I have a tendency, I will tell you everything, and I have a tendency to be brutally honest with myself and you. So, trades go against you. And as a matter of fact, like that Target trade, that was a daily winner. That's going to be something I completely forget about. But this Lulu trade that has been going against me, and I'm staying mechanical and I'm trading around it and trying to turn it into a winner. I took that thing from a massive loser, and it's still slightly a negative P&L, but it's very close. So, that's why we stay mechanical. And I talk about how you turn those losers into higher probability winners, rolling out straddles and strangles and stuff like that I'm short that aren't working out. I talk about all of that, how to collect more premium, how to increase your break evens, how to do all of that stuff. And one thing you can do with this that I wanted to mention, say, for instance, like we talked about with Kohl's, it's got the earnings in that next month, or in the March, and they didn't have the March cycle. But once those January expire, we'll probably get those March. So, but if you could do the March trade now, the nice thing about this strategy is if it's not working out, you could roll those puts out in time and collect more premium for it. So it would work. It will work with like the Jan May and the things of that nature. You just are going to need to continually roll those puts out in time. It will work. Just make sure the volatility is very tight, still within that 2% difference, because you're going to be paying a lot for time in the further, really far out duration, and you are not going to get paid as much for that in the nearer term. So you're going to need to roll those out more often. Okay, so this is the deal for this week is 2 months for the price of one. Like I mentioned many times, you get the daily market commentary videos where I talk about the good, the bad, and the ugly. I don't just talk about my winners. I think it's more important to talk about the losers, as a matter of fact. As a floor trader, that's all floor traders ever talk about are losers. It's because you don't remember those winners, and you don't learn anything really from the winners very often, but you learn from those losers. And I talk about those probably more often than I talk about all of the winners. The winners come and go. So, but the losers are the ones that are the challenge, and you spend probably 80% of your time managing into winners. So, and those are the ones you remember. And you get access to the 50, I think there's more than 50 even trading workshops now at this point, but you get all of them. Everything from, long puts, long calls, condors, strangles, straddles, collars, and how to protect your portfolios and stuff like that, especially from rising interest rates, things of that nature. One of the things that I'm very cautious about right now is that we're at all-time highs. Stocks, you got to start trying to lower basis on those stocks. So that's probably going to be one of the nearer or the next couple of weeks or so. We're going to be talking about how to lower your cost basis on these stocks that have had a lot of run up, and we're going to try and collect some premium against those. And so you also get the options trading lesson videos. Those are a little bit shorter than these hour-long videos, so you can kind of do like little refresher courses on them. They're great, and need to take advantage of those as well. So, if you want to learn to be like a real trader, you got to know all of this stuff. And I talk about the stuff that we had as top of mind as floor traders, and it's not really stuff that everybody else talks about. Not everybody else out there, for one, talks about the bad, the ones that are going against you, where I do. And I also talk about like little shortcuts, how to figure out how much intrinsic value is embedded in the money options and things like that, that will speed up your day and your process and make your life a little bit easier. No, I'm not giving you the exact penny when we're doing these little hacks, but I talk about different hacks on figuring out where the next earnings is coming up, even without looking on that chart on the expansion. I show you different ways to figure that out. I talk about where you can figure out what the dividend on a particular stock is even before they've told anybody. So all of that stuff is in there. So for the $97, it is well worth your money to learn all this stuff for sure. And you get unlimited access to me. Like I said, I have a no inbox policy for my email. I'm going to respond to you, and if I can't do it in an email, I will reach out to you by phone and we can talk through it, because I want to make sure you guys are all savvy. And people wonder why do I do all that? Why do I want to do it? For one, it keeps me really engaged, it keeps me on my toes. Two, if all of you guys become much better traders, we create better markets together. We don't always have to have the same idea on directionality and things of that nature, and we can all still be profitable even though we have differing opinions. The fact of the matter is if we all get tighter bid ask, we're all going to make more money. So that is huge in and of itself. And these courses are all designed to produce consistent winners. I talk about high probability trades. That's all I think about with regards to trading strategies, is how we can create high probability trades. And the link is in the chat box, you guys. So that's where you got to click on. It's not going to come up in this question box that we're talking about there. So you can click on that. It gives you a direct link to that. Also, you can go to Pro Trader Strategies premium subscription offer, options premium membership 2-for-1 deal. You can't really click on this, but you can jot it down. Easiest way to do is go into that chat box. And like I said, in later webinars, I'm going to be drilling down on different option components and when and where I find good trade strategy setups for that type of environment. You can also contact us at 310-598-6677 or email us at trading@protraderstrategies.com. I don't know what got written over that, but sorry about that. All right, SP, happy holidays to you, everybody. Hope you guys have a great new year as well. I'll be doing my webinar next Friday as well. So thank you guys all for participating. And when you guys participate, it makes this much better, I think. It makes it real. We can go through the steps of what I'm thinking in some of those. And, don't take it bad if I didn't like your stock and stuff like that, or the ones that you pick. It's just the way that I think, and I think that you guys should kind of start implementing some of that. If the stock isn't giving you a tight bid ask, you're giving up way too much edge to get in and way too much edge to get out. It's going to eat up your profits. So why even trade those? All right. All right, that's all I got for you guys. If you can't take that, take it easy. SP, you trained stock or took classes in stock? Sorry, you studied psych at Purdue? Oh, and taught at IU. Oh, nice, Midwest boy. Sorry, Chris, what did I say? What is your next subject next week? I think I'm going to actually do it on the covered calls because I think it's the time to talk about it. We've just had a massive move to the upside. A lot of people are starting to jump in. I mean, the brokerage firms are saying they are having record months of brokerage. And that's usually retailers coming into these brokerage houses like the TD Ameritrades and stuff like that. And one caveat to that is usually they say when the retail investors getting in, that means it's a top. And when the retailer investor is getting out or puking, that's the bottom. So I think it's a really important subject right now, especially if people are buying stocks up here at these high levels, is to start lowering that basis going forward. And SP, so I used to say, back to your psychology information, I used to say psychology was better education for me for trading than even having finance. Happy holidays, Farshid. So always keep that in mind. You know, psychology allows you to stay mechanical. You can kind of realize when you're starting to, you know, get emotional, and one thing you have to do is block all of that out. Once you can, we used to say on the floor even, once you stop going from thinking about making money and how much money you're making or losing, and start thinking about it as the probabilities and ticks, then that's when you've gotten over that hump. That's when you can really consider yourself a real trader, because money is emotional, probabilities and everything else is mechanical. It's playing the math, if you will. Yes, try to manage fear and greed. Lock it out. Just, you know, you stick mechanical, stick to the rules like I can teach you guys in these webinars, and make sure you stick to that. You know, if the rule's 50% of your max profit, take 50% of your max profit. Don't try and go for 75 or 100%. Your probabilities start decreasing rapidly. All right, Farshid is in for the covered calls. Awesome. All right, then I'll make a note of it, and we'll definitely do the covered calls next week then. All right, guys, take care. Merry Christmas. Have a happy New Year. But we'll see you guys before the New Year. So take care and stay safe over the holiday weekend.